How are you today? Can you hear me, please?
We are fine, sir. Good morning, sir.
Good morning, sir. We can hear you.
We can hear you, sir.
Good morning. I hope you guys saw my message on the chat room where I said the material for today's class is posted to your WhatsApp group. So go and get to your WhatsApp group. How was your week? Hope your week was fine. Okay, we can start this class, but let's do a run through of what we did in the last class. In our last class, we looked at basis period, where we said basis period is the defined period in the life of the taxpayer where the income of the taxpayer is subjected to tax. We also said we have what we call actual year basis, where we said an actual year basis is a base period that must have started and ended within the government tax year. We spoke about preceding year basis, where we said this basis period must have ended before the tax year, taking cognizance of the accounting year end. So in our last class too, we spoke about the commencement rule, the cessation rule, and the change of accounting dates. In our commencement rule, I said commencement rule, change of accounting date, and cessation rule was introduced as a result of the abnormality in the basis period. And you remember we said normal basis period has three characteristics. The first characteristic is that the basis period must not be more than or less than 12 months. We said it must commence immediately after the end of the previous one and must be on preceding year basis. And most of the time, when a company just commences operation, it is possible that the company will not have 12 months. So we spoke about how to assess a company that is just commencing operation, where we said 3 years as statutory. The first tax year will be assessed to tax from the date of commencement to the end of the first accounting year end. The second one will be from the day immediately after the end of the first accounting year end to the end of the second accounting year end. And I also said the third accounting year end will be a day immediately after the end of the second accounting year end to the end of the third accounting year end. And I said fourth and subsequent years will be on preceding year basis. So we also looked at how to allocate profits during this period where company just commence operation. We'll move straight to the next topic that last week. We started this about 2 weeks ago. We concluded last week. So last week too, we looked at when a company ceases operation. We spoke about things that could make a company to have a problem and would make them cease operation. One of the things that we spoke about is government could order, tax policy could make a company change their accounting dates. Sorry, could make a company cease operation. And there are several things: breach of contracts, liquidation by creditors, court order, and some other things could make a company cease operation. So we spoke about that in our last class. Having said that, we also now move to the principle that guides cessation of business. And I told you specifically that the principle that guides cessation of business is, we said, when the company ceases operation, the company will be assessed with tax from the beginning of the accounting period to the end of the business life. And we also said such a company must ensure that they file their returns and pay necessary tax within 6 months after the year end. We also said in my last class that there is possibility that a company has made income or expenses at the end of the cessation period. Therefore, if that is the case, any income or expense incurred at the end of the business life will be deemed to have been incurred or or accrue to the company and that is received on the day the company ceases to operation. And therefore, we said such will be adjusted on the terminal profit. We discussed all that in our last class. In my last class also, we discussed change of accounting dates, where we said where a company changes its accounting date, we have to determine some things. The first thing is to determine the first year in which the company failed for the first time to make its accounting date to the known date. And number two is to determine the 2 years subsequently after the year of change. That is, for example, if a company sees change the accounting date in 2020, 2 years after 2020, 2021 and 2022, you must determine those dates. And after that, assess the company to tax on preceding year basis using the old accounting basis, that is old accounting dates, and also assess the company to tax on the using the new accounting dates. And at the end of the day, we said compare the two and look at the one that gives the higher return. The one that gives the higher return is what you're going to make recommendation to the tax authorities to assess the company on. And that was what we discussed in our last class. We spoke about reason why company might decide to change the accounting dates. We said tax policy could be one of the reasons, and I cited example of Finance Act. I cited an example of 2005 when there was a recapitalization exercise in Nigeria where all banks were asked to prepare their account to end 31st December of every year. So invariably, every company that has been preparing their account to a date before that date, we have to change to this date. We spoke about to ease consolidation of financial statements is one of the reasons why company will be asked to prepare to change the accounting date. We talked about merger and acquisition. We talked about government policy and some other things. So those are the things we have spoken about in my last class. If you have not seen the video, please try as much as you can to go and watch the video if you missed those classes. So today we're going to be looking at two topics, just like I said. Number one topic is change of accounting dates. Sorry, I said change of accounting dates. Number one is our loss relief, and number two is cessation is concept of adjusted profits. Do you have any question? Where can we watch the video? Okay. All our video are on our YouTube channel. Just look for Equity Professionals Limited on YouTube and search for the videos that will be relevant for your classes. Okay? You have uploaded all the videos. Ooh. Good morning once again. So, when a company makes loss, basically, the act that regulates Nigerian tax says that when a company makes loss, such a company is not expected to pay any tax. Okay? Because you can't make loss and you're still expected to pay the tax. So the provision of Company Income Tax Act and Personal Income Tax Act stated clearly where the company makes loss, that such a company is exempted from tax liability. Therefore, we are not expected to pay tax. Okay, kindly share the video link. Among me, that will be shared after the class. Thank you. So, we said that when a company makes loss, such a company will not be expected to pay tax. Okay? And in that regard, that means the operating expenses has exceeded the income or revenue of the company. And at that instance, the company had made loss. You remember that in your mathematics, we will say loss is equal, business mathematics now, we will say loss is equal or is a situation where your cost price is greater or more than your profits or selling price. That is, the cost price is more than your selling price, you will have a loss situation. So if that is the case, that means the same thing is applicable here. When a company makes loss, such a company is not totally expected to pay tax. Now, having said that, when a company makes loss, there are two scenarios where we're going to be looking at. The first scenario is when a company just commence operation, and when a company is has been in business for so long. But before we move to that, we're going to be looking at two different types of losses that we have. Now, the first type of loss that we have is carry forward loss relief. Carry forward loss relief. So I have explained that when a company makes loss, such a company will not be paying tax, and they are allowed under the tax law to relieve the loss against income of the subsequent year. The taxpayer is allowed, okay, the taxpayer is allowed to relieve the loss that have been made against profits in the subsequent year. That means if the company makes loss this year, by next year, the company makes profits, the law permits that the company's loss can be relieved against the income of the subsequent period. Okay, so that is that about that. So, and I said we have two types of loss relief. The first one is a carry forward loss relief. The first one is a carry forward loss relief, where we say when a company is operating on carry forward loss relief, the characteristics will be as follows. Number one, such a company will be granted loss relief automatically. The loss will be granted automatically. That is, the taxpayer does not need to apply for loss to be taken against their profits. So you just take the loss and relieve it straight. You don't have to be telling tax authority that I've made loss, so I want to relieve it. No, you don't need to apply. Number two is that the loss of a source can be carried forward against the profits of the subsequent period indefinitely. Okay, but ensure that the loss of a source is relieved against the income from the same source. By implication, for carry forward loss relief, you cannot take advantage of the other sources of income. If the company, peradventure, has more than one source of income. For example, a company that is operating insurance business would most likely have various sources of income. They will have life, non-life, and some other things. So if you make loss in the life business, you cannot take advantage of non-life business. That's what we are saying. The next one, it is applicable to all kinds of businesses, whether it is ally business, whether it is manufacturing, whether it is trading. It is applicable. Now, Finance Act 2019 gives the insurance company a leeway to also be able to carry their losses forward indefinitely. Before now, Finance Act restricts insurance company from being able to carry their losses forward indefinitely. Meanwhile, it is restricted to 4 years. But with the effect from 2019 Finance Act, a company that is operating under insurance business can now carry forward its losses indefinitely. Okay. This loss is relieved on preceding year basis. The next one is current year loss relief. For current year loss relief, it is granted only to individual. You have to have written application before this loss can be relieved, and the maximum period of the loss can be carried forward is 4 years. At this your level, examiner is not expecting you to do loss relief at this level. When we get to case study, I'll show you the applicability of loss relief, but you just need to know and understand the basis, the basic principle of loss relief, okay? And for this type of loss, which is current year loss relief, the loss of a source can be relieved against income from every other sources, only in the year in which the loss occurred. That is, it is only in the year in which loss occurred, that is when the loss can be relieved against income. Having said this, we now move to the next one, which is the applicability of this loss relief. Now, assume we are talking about the current year loss relief. Assume in SAT Limited in 2016 tax year incurred a loss of 14 million, but made profit of 5.5 million. Such a loss can be relieved from 2017 tax year, and the unrelieved portion can be carried forward indefinitely until it is fully relieved. Okay, so this guy had made a loss of 14 million this year. By next year, the company makes profits of 5.5. The company has rights to relieve it until it is fully utilized. The company is fully utilized the loss. Okay, so that is that. Omobi, you are new in our class. Kindly introduce yourself. Obed, you are new in our class. Ogenetega, you did not come last week. Shola Olabi, you were not in the class last week. Introduce yourself, guys. Omomi, we are waiting for you.
Good morning, sir. Good morning, everyone. My name is Yendiniwu Omomi. I work as a finance executive in a marketing agency.
Thank you. God bless you, Mumi.
Good
Next
morning, everybody. My
Obed,
name is Abutu Obed, and I work as an auditor in an audit company.
thank you, Obed. Obed, long time. I've not seen you for some time. I know you physically. Welcome again.
Yes, sir.
Again, where did you go to last week? We did not see you in our class last week. And you were in the class last 2 weeks. What happened? You don't want to talk. Or you don't know where your mood is. Okay, we'll move on. If you are new in the class, so you kindly introduce yourself, please. I think Shola is new in the class. Shola, are you new? Okay, yeah, I know Shola too is new in the class. Yeah, thank you. Shola has just responded. All right, thank you, Shola. Okay, we can move on. So, as I was saying, I said this company can actually relieve its losses on a going concern basis without any restriction. Okay, so that is that. And it is not the same thing for an individual that wants to relieve his loss. Why? Because we have said that individual that wants to relieve his loss can take advantage of other sources. Okay, But that will only mean in the year in which the loss occurred. Imagine in this situation. We said, assuming Mr. James in 2015, year of assessment, incurred a loss of 15 million from his transport business, but made profit of 2 million from Gary professional service and 5 million from his hairdressing shop in the same year of assessment. The law permits him to utilize 7 million profits he made from these other sources of income to relieve against the loss he incurred, leaving us with what? 7 million that is unrelated. That 8 million that is left, that is unrelieved, that is what he has done is that he has taken advantage of the other sources, which is 2 million plus 5. He now has 7 million. So he has taken advantage of the other sources and has 8 million left. This 8 million that has not been relieved, you cannot take advantage of other sources again. The source that you have made loss, which is from transport, you must make profit from there. It is that place that you can now relieve your loss. Note, however, that if this company is unable to relieve this loss, after 4 years, the loss becomes irrecoverable. Okay, that is that. Any question? So we'll leave this at that. So I put a summary of our differences in the table. Now, when a company commences operation in the past, the tax law specifically was biased to taxpayer. In the old tax law, when a company commences operation, we would say the company will be assessed the tax from the date of commencement to 31st December of that year. And in the second year, we will say from the date of commencement again to the first 12 months. Now, when you look at that, for example, you will notice that that has made it so important to the taxpayer to the extent that the profit of the taxpayer will be subject to tax more than once. So taxpayer will always file with tax authority when they commence operation because of what? Because there is overlapping of basis period. This overlapping of basis period has a significance on the profit of the taxpayer because their profits will be subjected to tax more than once, most of the time. Therefore, this gives the taxpayer some rights in the tax law to assess their tax or to challenge the tax authority and request for their right of election. Therefore, we say under the old tax law, before the finance, I will say taxpayer has right of election. In the old tax law, under the loss relief computation, when the company just commence operation, the problem is always that the losses will be accumulated. Profit does not accumulate. Excuse me. Because we charge profit or tax in the relevant year. But losses accumulate. If you don't make profit, you carry forward the loss to the next year. You carry forward to the next year. You carry forward to the next year. I mean, so the loss of this year added to the loss of next year will continue to accumulate. Okay, because the losses accumulate during commencement, there is every possibility that the loss that we have incurred during commencement is now even more than your accumulated losses. Therefore, the Act says that if this kind of situation occurs, the taxpayer will have to restrict the loss to the actual loss incurred during commencement. Thank God for Finance Act. Finance Act came to remove the overlapping of basis period. So there will not be need for us to have accumulation of losses again in our computation because Finance Act talks about removal of all these overlapping. Any question at this point before we continue? Any question at this point? Any question at this point?
No, sir.
All right, thank you, Obed. Okay, now for loss relief, loss has priority over capital allowance. So in a situation whereby a company has capital allowance to recover and also has loss to relieve, the first one is to first relieve your loss. Okay, loss has priority over capital allowance. The next one, loss of the current year has priority over the subsequent losses that the company will make. So what I am trying to say here is that if the company makes loss of 10 million today, okay, makes loss of 10 million today, and it makes loss of, let's say, 5 million tomorrow, loss of today will take priority over loss of tomorrow. Okay, so that is what we're talking about. Mr. Wellington, good morning.
Good morning, sir. Good morning,
How are you,
class.
sir?
I'm
Yeah.
good, and you, sir?
I'm okay, sir. All right, sir. So we are saying that the loss of a source, loss as priority or loss of a current period as priority over loss of the subsequent period. So if you make a loss today, the loss of today has priority over loss of tomorrow. That's what we're trying to say. Now, where the amount of loss, where the amount available for after the loss has been relieved against the assessable profits and is not enough to cover the capital allowance, the maximum to be able to take is the difference between the loss and the profit, not minding the provision of capital allowance that says capital allowance shall not be more than 2/3 of the assessable profits. Okay, Mr. Wellington, mute your mic. Not minding the position of the act that says that capital allowance shall not be more than 2/3 of the assessable profits. Not minding that. What we are considering here is that your capital allowance will be in that situation where your capital allowance is not enough, your profit is not enough to cover the capital allowance in that year. We are saying the maximum capital allowance that can be released in that year is different between your assessable profit and your loss. Will be the maximum that the taxpayer will claim for that year. You cannot claim more than that. That is that. So I have explained this. And capital loss as priority over capital allowance. Now, when the company ceases operation, you cannot carry backward loss. Unlike the way you can carry backward capital allowance. When we get to capital allowance, I'm going to show you all this. You cannot carry backward your losses. When a company makes loss, if the company is unable to relieve the loss till they get to the year of cessation, no problem. The act does not permit the taxpayer to carry backward losses, unlike the way that you carry backward capital allowance. You cannot do that for loss relief. So that is that. In the next one is for us to look at practical illustration of how to deal with loss relief. I said, let's go. Kule, a sole proprietor, commenced business at Lackwell. The same principle is applicable, so don't look at that sole proprietor this thing. Commenced a business at Lackwell on 1st March 2016 and chooses 31st May every year as its permanent accounting date. The adjusted profits / loss of the business for the first few years of trading are detailed below. Period to 31st/05/2017. The company made loss. Year ended 31st/5/2018. The company has a profit. Year ended 31st March 2019, profits, and so on. You are required to compute the total income of the taxpayer for the relevant year of assessment. In my last class with you, I taught you how to determine the relevant year of assessment, where I told you that to determine relevant year of assessment, especially when a company is just commencing operation, you must know the principle that guides commencement rule. I will remind you, for those of you that were not in my class last week or an upper week, when a company commences operation, we said the company will be assessed with tax from the date of commencement to the end of the first accounting year end. In this regard, the date of commencement is 31st of March 2016, Abby, and this company chooses 31st May annually as its accounting dates. I'm here, guys. So, sorry, I had to pick a call. So, as I was saying, when the company commences operation, I said the company will be assessed with tax from the date of commencement, which is 1/3/2016 in this situation, to the end of the first accounting year end. In this situation, is 31st March 2016. And from our principle, this will be assessed with tax when? This will be
Hello, sir. Is
assessed
it 31st March or 31st May?
31st May. May. Excuse me, guys. Sorry, let me pick this. Sorry, guys. So, from the date of commencement in this situation is 31st March 2016. The first accounting year end in this situation will be 31st May 2016, right? And the relevant accounting year end, what will be the tax year? For those of you that have been in my class, what will be the tax year? Relevant tax year for this guy?
2017, preceding year basis.
2017. 2017. So this will be 2017. So that means the first tax year will be 2017, right? Hello, guys.
Yes, sir. Yes, sir.
Okay. The first tax year will be 2017. That means what will be the last tax year in this situation? You remember, knowing fully well that this would have started from 1/6/2019. So to this date, what is the relevant tax year of this guy?
2021.
2021. So if I want to prepare my computation now, I would have said computation of taxable income for 2017 to 2021 year of assessment, right? To 2021 year of assessment. That is that. So those are my relevant year of assessments. But examiner also said I should compute the income. So let's go. In computing the income, I'll go to the next page. So when the company commences operation, we said the company will be assessed with tax from the date of commencement, that is 1/3/2016 to 31st/5/2016. But in this situation, the company made loss when you look at it. And I've told you again that whenever you see period two means from the date the company commenced operation. That is, in this situation, it means from 1/3 2016. How many months is this guy? From 1 2016 to 31st 5 2007. How many months is that? Who is helping us out? How many
15
months?
months.
15 months. 15 months. But don't forget that we will need from 1/3/2016 to 31st May 2016. Are you sure that is 15 months? So let's count. That is March, April, May.
3
So that's
months.
15 months. So this is 3 months, Abby. 3 months.
3 months.
Yes, 3 months. This is 3 months for the first year. But when you look at this entire period, you will notice that it's still within this period, right? So out of this, I need this period. Don't forget that this ended 2017. That is, the entire month here is 15 months. Within these 15 months, I have 3 months. So what will I do? I'll just say 3 over 15 multiplied by the loss by this value will get my loss for the year. So when we get to so that is how we got this number. So what we actually did was to take this, and that is a calculation here. 3 over 15 multiplied by 1,289,400. We will have this. So, and that is the basis period. In the second tax year, 2018. In 2018, which is the second tax year, we have said when a company commences operation, in the second tax year, we are going to assess the company tax from a day immediately after the end of the tax year. That is one after the end of the first tax year. Sorry, a day immediately after the end of the first accounting year, which will be 1/6/2016 to the end of the second accounting year, which is 31st May 2017. I have this. So, but don't forget that we still have a loss that we are bringing forward. So I'll bring the loss forward, which is 257,880. The loss for the year will be 12 over 15 multiplied by the loss, which is this. It gives us 1,031,520. As I was saying, this will now be for the year. So I'll add the two together, the one I'm bringing forward and the one for the year to have the total loss. Now, in the old tax law, this would have taken us to like third year and the loss would have accumulated. But I don't want to bore you with that old tax law. I'll just focus on the new tax law. So, and that is it. You have this. So you will notice that the loss only took the first and the second year. And that is it. Now, in the third tax year, we said the company will be assessed with tax from a day immediately after the end of the second accounting year. A day immediately after this date will be what? 1/6/17 to 31st/8/18. But in this period, the company made profits. Look at it. There was profit of this. So I'll bring the profits in and call it as income. The loss that I incurred in the prior year, I'll bring it in. So loss brought forward. Loss for the year is this. Sorry, the loss relief for the year. I will leave the entire profits. The entire profit is relieved. So The carry forward now will be different between this, that is a loss, and the profit. You have this to be carried forward. So you relieve the loss against the profits, or you are relieved against the profit. You have a balance. The second year, they made profit of this. You bring this forward, this, we relieve it against the profits. There is no restriction to the amount of loss you can relieve. You can relieve the entire amount. There is no restriction. So the same thing for this. What I have here, I'll bring it forward. I made profit in 2021. I bring the profits, relieve against the loss. And I think that is the end of the question. So you can see that loss relief is not a big deal. Okay, it's not hard. It's just for you to know when to relieve your loss. Do you have any question? Any question? Any question? Any question? Okay, in the absence of no question, we are done with loss relief. We move to the next topic. You can look at the next illustration on your own and just start with. There is no issue about that. But let's go to the next topic.
Excuse me, sir.
Yes. Go
Hello,
ahead.
sir. Okay, I'm kind of confused with this commencement rule and the one that is applicable to loss relief, in the sense that I know for commencement rule, the application is from the date of commencement to 31st of that same year.
No, no. Finance Act
So,
has changed.
sorry?
Finance Act has changed that.
Okay. So with effect from 2019, this is one that is applicable now from the date of commencement to the accounting year end, right?
Good. Yes.
Okay. Thank you.
All right. So we'll go to the next topic for today. Our next topic will be stop sharing. Credit profit and loss adjustment. Now, this topic is the topic I've been teaching you from the beginning of the class till now. Is synonymous with someone that is doing financial accounting. That when you are doing financial accounting, they will first teach you accounting concept and convention. They will tell you that we have two types of accounting, real and nominal accounts. After that, they will go to the double entry principle. They will take you ledger. They will take you trial balance. This is just like my own trial balance. I have taken you double entry principle. Okay, I've taken you double entry principle, which is my basis period is like double entry principle. Loss relief is like my ledger. Now I am going to my trial balance. It is very important that you understand all this topic very well, because they are going to be our bedrock for all other topics that we're going to be teaching. Okay? So that is that. Now let's introduce ourselves to the concept of trading profit and loss adjustments. Now, when you talk about trading profit and loss adjustments, we are simply looking at the way a tax authority looks at the profits and the way financial accountant looks at the profits. The two of them, they have varying perspectives. The first perspective is that the accountant uses GAAP, uses IFRS in preparing its own financial statements or its income statement. When taxpayer or tax accountants want to compute tax accountant does something else. Tax accountant will look at it from a perspective of tax law. Therefore, the two of them at every point in time will never have the same profit because there are some income or expenses that will be recognized in the tax law or in the financial statement that will not be recognized in the tax statement. So, for example, depreciation. Every one of you know in this class, because you are not new to this topic, to this class, or to this course rather. Every one of us in this class knows that depreciation is not an allowable deduction. Why is depreciation not allowable? Number one, depreciation does not constitute movement of cash. Depreciation does not constitute what? Movement of cash. And when you're talking about movement of cash, in taxation, you must have incurred expenditure before we recognize the expenses. Even if you have not incurred it, you must have had a commitment. Commitment. You understand? But in profit and loss accounts, depreciation is just a historical spread of the costs over its estimated useful life. You have acquired an asset, you are just spreading the cost. It's not as if you are incurring any cost. So you are using that to reduce your profits. That is the way tax law looks at it. That you are just using the depreciation to reduce your profit, the taxable profits. And that is why in tax, capital allowance was introduced as a replacement for this depreciation. Capital allowance was introduced as a replacement for depreciation. What do we mean by that? Capital allowance talks about, we said, when an asset is incurred, it is an allowance you grant to a taxpayer that has incurred qualifying capital expenditure. We simply also say that capital allowance is the allowance granted in lieu of depreciation. That is, because we now know that depreciation is not an allowable reduction, then something must compensate for that. So if you as an accountant has recognized depreciation in your income statement, we are saying depreciation is not allowed. Number one, that's number one reason. Number two reason for depreciation not being allowed is that there is no standard in your so-called financial reporting or in your financial standard, in your international financial reporting standard, that says that all the taxpayer, all the user of financial statements must use the same depreciation method. Therefore, I can come and say, I want to use reducing balance method. I want to use straight line method. I want to use production method. I want to use diminishing balance method, weighted average method, and so on and so forth. You want to use so that different depreciation rates, depreciation method that the taxpayer can adopt. Also, there is what we call rate inconsistency. The tax law, the financial accounting does not simply say you can use any rates, does not give you the rate that you can use. Some company can decide to use 10%, some will use 5%, some 20%, some 25%. There is no standard. Therefore, given the fact that there is no standard rate, the tax law now says, okay, depreciation said we will not allow it because all this inconsistency that it has brought into the system is not going to be able to place the taxpayer on the same pedestal. You cannot compare different taxpayers. You can see there is problem. Because of this, depreciation is not allowed. So there are several of it that the taxpayer would have done in the course of the year that would not be an allowable reduction because the tax law does not permit it. So therefore, the taxpayer will first bring his income statements that the tax payer has used the financial reporting standard to prepare, then we will now adjust it to be in compliance with the tax law. And to do this, you must know some certain things. What are these things? We must know that we have what we call allowable expenses, and we have what we call non-allowable expenses. What is allowable expense? What is allowable expense? We say 4 criteria will make an expense allowable. Number 1, when you talk about allowable expense, say an allowable expense is the expense that must be wholly exclusive, reasonable, and necessarily incurred for the purpose of generating taxable income. Having said this, we now know that it is an income or expense incurred to generate taxable income. The next focus here will now be when you say an expense is wholly, what do we mean? An expense will be wholly where the entire amount is incurred with respect to the business. You have incurred the entire amount. That is wholly. Entire amount. Underline entire amount. The entire amount would have been incurred in the business. That is, you are not sharing the expenses.
I want to spend my laptop.
Usayo, you have a question.
No, sir.
Okay, now. Say outside to your baby, Usayo. All right. So we said,
All right, sir.
all right. We said the income must be what? Wholly incurred before you can say it is allowable. That's one. Number 2, exclusive means no other part of the business will share from this. You don't share, so the business alone benefits from these expenses. Business alone benefits from these expenses. So we say this is an wholly incurred expenses. The next one, we say necessarily incurred. What do we mean by necessity? Necessity here means without incurring that expenses, the business cannot function. We want to do online class. And in our online class, what is very important is we must have connection, internet connection, right? And at the same time, we must have Zoom. You remember when we started our first class, the class was being intercepted every 40 minutes. Why? Because we had paid for Zoom license, but they've not granted us the license. So without paying for that license fee, we will not be able to hold this class successfully without interruption. 40 minutes in had gone. You don't go. That is to tell you that any expenses we incur with regards to payment for Zoom license is necessarily incurred. For us, in our VI center and our solo center, we are saying that if we have incurred rent is a necessary expenditure that, because if you don't have a facility to use, where are we going to gather students to teach? So it is very important that we have that. So we are saying that for expense to be relevant, it must be necessary. For it to be allowable, rather, it must be necessary. And it must also be reasonable. It must be reasonable. So reasonability determines how the expense will be incurred, will be allowed. Trend is very important. Last year, 3 years ago, you have been paying your salary, your worker, salary of 10 million per annum. The next year you pay 12 million. Oh, the subsequent year you pay 13 million. In the subsequent year, you now pay 200 million. What happened? You that you are paying 10 million for staff, 12, 13, all of a sudden, you just jump to 200 million. Basically, because maybe that year sales had increased, that you now made such big amount of money. You're now looking for a way to cut your tax to quickly increase your salary of your staff to that amount. The tax authority will not take that. They want to follow trend. What is it that you did that you have to give your salary, your staff this amount of salary? So all those things are very important. So that is that. So when you now say non-allowable expenses are the expenses that are not wholly exclusive, reasonable, and necessary for the purpose of what? Generating taxable income. So that is that. We move on to the next one. The next one now is, let's look at the formats. You know, I told you that we are adjusting the profits of the taxpayer, the profit that have been prepared using the financial reporting standard. So you will adjust that. Now, in adjusting that, I'll first take my net profit. My net profit, I'll bring it in. Now, I will add non-allowable expenses. Why are we adding it back? Non-allowable expenses had impacted our income. Therefore, the impact that this had on our income is a negative impact. To correct the negativity, what do? We add back. Example. I want you to understand this very well. For example, assuming the company made a net profit of 150,000. But before making this profit of 150,000, that is, 150,000, depreciation of 70,000 had been included before making this profit. What has this depreciation done to your profits? What has this depreciation done to your profits? What has this depreciation done to your profits?
Hello, sir. Sorry, I didn't get your question.
Okay, I will have a question. I said, imagine that a company made a profit of 150,000. Imagine that a company made a profit of 150,000. Okay. And in that profit that they made, before arriving at the profit, they had incurred 70,000. Okay. What will be the impact on your profits?
The profit would have been reduced
By this 70,000. Abi, to correct the error, what do?
You had it back.
So what we are saying here is that non-allowable expenses that has reduced our profit before will be added back. We are adding it back. Taxable income omitted. Let us assume that we have an income of 80,000, but erroneously or mistakenly, the taxpayer had removed it and got a net profit of 150,000. KP, welcome to the class. K, welcome to the class. I know that you just came to the class. So what will be our listing? What will be our profits? What will be our profits? Please help us out.
Sir, please, can you come again with the question? I did not hear you well.
My question is, assuming the company, can you see my screen? Makes a profit of 150 million. And in that 150 million that they made, when they are doing tax investigation, they notice that 80 million was omitted. What has that done to our profits?
It has reduced
Increased
the
it. Oh.
Or reduce it?
It has reduced the profits.
It has reduced the profits. To solve the problem, what do we do?
You add it back.
Who is not getting these concepts? Who is not getting these concepts? So we are saying this scenario, the company made a profit of 150, but out of the 150, they have intentionally removed 80,000 or mistakenly removed 80,000. Ordinarily, their profit would have been more than that, but they removed 80,000. So if you notice that, what do? Add back. So we also add the 80,000 back, making 230,000 that is supposed to be our profits. So we are saying, what I'm saying variably is that when an income is not included, whether it is omitted erroneously or deliberately, such an income will be added back. Taxable income now. The next one is non-taxable income included, non-allowable expenses included, or allowable expenses, non-taxable income included. So for non-taxable income included, what are we saying? We said this income is not taxable, but it has been included before arriving at our profits. Let us assume again, our profit is 200,000. That's the assumption. We are now saying that we have an income of 10 that has been recognized before arriving at this 200,000. 10,000 has been recognized before arriving at 200,000 to get this net profit. And we now said this 10,000 is supposed not to be there. What is the impact of that on our profits? Has it overstated our profit or understated our profit?
It has overstated our profit. It has overbloated our profits.
Yes, overstated our profits, right? So to correct the error, what do?
We have to reduce it to that figure, by that figure.
We have to reduce it. So we are removing it. So that is why we are subtracting that 10 from this guy. Allowable expenses omitted. We're told that the profit is 180. But our allowable expenses is 50. And it was omitted. What would that have done to our profits? Overstated or understated?
It would have overstated our profit.
So to correct the error, what do?
We have to reduce it by that figure.
We reduce it by the figure. It's only Mr. Wellington that is in class today. I am assuming every other person are not in class. So
that's that question now.
Oh yeah, including Wumi. No other person is in it. Okay.
So I didn't know you called my name the other time, and I tried to answer. Yeah.
Okay. Now, everybody, when I ask question, just say something. Don't just keep quiet. Okay. Someone is sending us a message. So, let's okay, we are with you. Okay, Oshola, I've heard, because I'm not hearing you speak. So, let's go. Let's now discuss all these example or type of non-allowable expense. We have various types. So, over the years, I have studied the past question and I've also studied the acts. These are the types of non-allowable expenses that you should be expecting in the exam. We are entering your advanced tasks gradually, so please don't always miss classes. It's not advisable. Capital expenditure. We all know ordinarily that capital expenditure is not an allowable reduction. Why? Even in your income statements, they don't put capital expenditure. And that is why when you first started your public sector accounting, your public sector lecturer there would have taught you that we have two types of expenditure. Abi, you will say we have recurrent expenditure and we have capital expenditure. Capital expenditure is the expenditure that will last for more than 1 year. So an expenditure that is more than 1 year in the income statement will not be allowed, right? It's not always allowed. So that is it. Capital expenditure. So that is it. So anywhere you see capital expenditure is not allowed. But not however. Overhauling of fixed assets is also capital expenditure. Abi? Refurbishment of fixed assets is also capital expenditure. When you acquire a cost prior to the usage of the asset, it will be capitalized. You have done property, plant, and equipment in your standards. It will be capitalized. Any custom duty acquired, any custom duty paid at the point of acquisition of the asset will be capitalized. VAT paid at the point of acquisition will be capitalized. Freight charges paid at the point of purchase will be capitalized, because those are the things the act your financial reporting standard says. All those things are capitalized. Cost of installation. When you install an asset, that cost will also be what? Capitalized. Having said that, when you repair your fixed assets, repair cost is unreliable expenses. Repair cost is unreliable expenses. So you have to note that. It's not the same thing as refurbishment. It's not the same thing as overhaul. When you say you refurbish or overhaul means replacing an essential part of the assets. Imagine you have a motorbike, and that motorbike, you replace the engine. Engine is an essential part of the asset. You now replace it. You now want to expense it. No, it has to be capitalized. Do you understand? That is it. We move on to the next one. Private expenses. Any private expenses are not allowed. Private expenses are not allowed. So such do not be allowable expenses. We do not allow provisional items in tax. You cannot be provisional. All expenditure must have been incurred. Don't make provision for the future. Before you recognize expenditure of such must have been incurred. So that is why people can accrue, okay, because you have incurred their expenses. It's just that you have not made payments. Okay, such is very important. So when you make provision for accrual, such will be allowed, provided you can provide evidence of work done that we have not made payments. Maybe they've not submitted their invoice, but they have done your work. You can make provision for that. But any other thing apart from that is not allowed. Depreciation is not allowed. Food, liquor, wine are not allowed. I cannot be giving you contract and I'll still be the one feeding you. Charge it as part of your contract fee. I'll pay it. Legal expenses is allowed, provided that the legal expenses include the following. Number one, cost of settling disputes among customers is allowed. But when you take the tax authority to court, hope you are adjusting all this thing. When you take the tax authority to court, cost of tax appeal, whether successful or unsuccessful, are not allowed. Cost of tax appeal, whether successful or unsuccessful, are not what? Allowed. They are not allowed. Do you understand me? Whether they are successful or unsuccessful, they are not allowed. So you have taken the tax authority to court and your case, you won the tax authority. So what we are saying here is that you have won, no problem. But that cost, don't bring it to us. It is not allowed. The next one, losses recovered under insurance or contract of indemnity are not allowed. The next one, loss on disposal of fixed assets are not allowed. When you incur loss on disposal of fixed assets, they are not allowed. When you make payments to an unauthorized pension fund, is not allowed. Loss on disposal of investment is not allowed. Withdrawal out of capital is not allowed. Defalcation is not allowed. Staff loan written off is not allowed. Customer loan written off is not allowed. You are not a bank. You can't be writing off loan. But if you want to write off bad debt of the taxpayer or customer rather, which is loan written off, no bad debts now, there are conditions for you to even write off bad debts. Number one is that you must have taken all reasonable steps to recover the debt by going to court. And you've gone to court, you could not recover it, then we can now say, okay, this debt is concluded and it cannot be recovered again. Preliminary expense not allowed, stamp duty is not allowed, appropriation items not allowed. The next one is lease. We have two types of lease. We have the long-term lease and short-term lease. Both the acquisition of short-term lease and the renewal acquisition of short-term and long-term lease are not allowed. Meanwhile, renewal of long-term lease is not allowed. Renewal of short-term lease is allowed. I'll say it again. Acquisition of short-term lease and long-term lease are not allowed. Meanwhile, renewal of long-term lease is not allowed. Again, renewal of short-term lease is allowed. Renewal of short-term lease is allowed. If you are there, I am there. Any question at this point? Any form of tax is not allowed. You want to ask a question? Go ahead. Any form of tax not allowed, except for value-added tax on expenses.
Excuse me, sir.
Yes, Kelvin.
Yes, sir. When you were speaking in terms, when you were explaining that capital allowance, I did not that capital expenditure. I did not get the whole explanation there.
I said it's not allowed. Capital expenditure is not allowed. And I gave you an example that capital expenditure could be in form of overhauling of fixed assets or refurbishment. And I said refurbishment of fixed assets is not an liable expenses because it should be capitalized. Oh, excuse me. Because it should be capitalized. Do you understand? That's what I'm saying.
Yes, sir. Thank you, sir.
All right, Kevin. Any other question? Subscription is allowed provided it is trade subscription. Don't go and pay subscription to your church. Say, Holy Mary Club or St. Michael Club, now go and pay subscription. It's not allowed. But if you are paying subscription, you can pay to ICAN or professional association that is being recognized by the law. Bad debt is not allowed, but it can be allowed provided such is part of trade debt. You have taken reasonable steps to get the debt back. That's donation. Donation is allowed, provided that you make donation to the list, to the body listed in the act. We have the body listed. So why any expenses incurred in generating tax exempt income is not allowed. So we have said the income is not allowed, and the tax authority will not. So the income is not taxable. Rather, any expense incurred in generating income not taxable, we cannot bring it in as allowable expenses because we are not taxing the income, right? Because we are not taxing the income, any expenses you incur in relation to that income is not allowable. The next one is any compensation that is paid under the regulated market is not allowed. Payments paid under the regulated market between buyer and seller, that is borrower and the lender, is not allowed. And so on and so forth. Bad debts, we have two types of bad debts. We have the specific one and general one. When I say specific bad debts, what does that mean? Specific means that I can trace the debtor. I know the debtor, I can trace them. So if a debtor is owing me, I can actually trace the debtor and recover my expenses from the debtor. However, if the debtor cannot be traced, then that is not what is it called? That is not allowed because it's not general debtor. You don't know him. Unlike specific debtor, that is why banks we always do what we call KPI. I said KYC rather. Know your customer. They want to know you. When you register a bank account today, the bank will trace your address. They have people that will do that for them. They will ask, do you know this person? Does this person live in this place? They do that a lot as banks. So that is that. So any general debtors are not going, you are not going to allow any provision we make for them, but specific debtor, when you make provision for them, such will be allowed. Taxable income omitted. We have said it is taxable, but it was omitted, maybe in an error. Such will be included and will be taxable. Next on non-taxable income include the following: sales of fixed assets, sales profit of investments, profit on disposal of fixed assets. All these are not taxable. Dividend is not taxable. Bonds, bonds, treasury bills, all these are not taxable. Illegal income, such as bribe, are not taxable. Okay? So that is that. Let's quickly look at an illustration. So this is how the question will look like. The examiner will give you question with case study, but don't mind them, just focus. Let's look at this illustration together. Someone should read for us, please. Someone should read for us. Someone should read for us.
Mr. Bank who has worked in a neighboring African country for many years, returned to Nigeria in August 2018. He incorporated a private limited liability company whose bank who a, a private limited liability company known Bank Moon Limited, located in Lagos on October 30th, 2018. The company deals in processing and packaging of plantain chips for consumption. The directors of the company opened a business bank account with one of the leading commercial banks in November 2018. The company commenced full operations in January 2nd, 2019. Your firm, Tumininu and Co., was appointed as the tax consultant to Bank Moon Limited in January 2021. At the first engagement meeting with the company, you discovered that the company was yet to register with the Federal Inland Revenue Service. Relevant tax.
Look at that statement. At your first engagement with the company, you discovered they've not registered with the what? Federal Inland Revenue Service. They've not also registered for VAT. There are penalties for this. In this question, we are not bothering you with that because we have not gotten to company income tax where we talk about penalty for not filing returns. Not gotten it. Excuse me, guys. So this company had not registered. When the company has not registered, they will be fined. Failure to register is a fine under the tax law. You must register within specific period. Okay, but let's go ahead. Now, we're not given turnover. A6. The reason why the examiner gave this turnover is because of the new tax law that talks about medium-sized company, small-sized company, and large-sized company. Okay, but in this regard, we will not bother ourselves with that. We are still building our case. Now, we start from this. Look at it. The examiner will give you income statement. Here, they are giving us income statements. And they will give us the net profit, right? The first thing you will need to do is look at the requirements. The examiner says you are required to compute the adjusted profit for the relevant year. Okay, so in doing that, we'll start from the net profit. We take our net profits. We now start looking at the additional information. Based on what we have discussed today, number one, additional information talks about Lagos Chamber of Commerce. So, before Lagos Chamber of Commerce, we have donation there. Abi? Donation generally is an liable reduction, but we have to be very careful to ensure that we do not go and accept what is not supposed to be accepted. So, for that donation, under donation, we have Lagos Chamber of Commerce. Is Lagos Chamber of Commerce allowable or not allowable? Lagos Chamber of Commerce, allowable or not allowable?
Allowable, sir.
Lagos Chamber of Commerce is allowable. Motorboat Club, allowable or not allowable?
Not
Not allowable.
Mr. Hussein, you are welcome. Not allowable.
Yes.
Polo Club, Polo Club, allowable or not allowable?
not allowable.
Are those the only two students in the class? Political party, allowable or not allowable?
Not allowable, sir.
Not allowed.
Yes. Approved National Relief Fund, allowable or not allowable?
Allowable.
Allowable. Okay,
Allow-
now, good, allowable. Good. Now, these ones that are not allowable, we will go and take them back against the profit. You remember what I said? When an expense is not allowable, what do we do? With the salaries, we add it back. This should be added 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 back. You are not going to do anything to this last one. Do you understand?
But sir, I think the first one is allowable.
Yes, the first one is allowable. We are not going to
So
do anything with Lagos Chamber of Commerce because it's allowable. And but these three will be disallowable. Will be disallowed. We move on to the next one. The next one is bad debts. Allowance for bad debts, when you see it under examination condition, is not allowable. Allowance for bad debts is not allowable. This is general provision. The next one, specific provision, that will be allowable, right? Yes. The next one. Court fine under miscellaneous. Is it allowable or not allowable?
Not
Not
allowable.
allowable.
One thing I want to recognize or realize is that you see all this value, this 93, it is taken from the income statements. Look at it. So they are giving you the breakdown of this 93. Do you understand what I'm saying? So this 93, the same thing with this 7245. When you go to the income statement, you see the 7245. This is supposed to be 7245. Okay, that's an error there. It's supposed to be 7245. Okay, the next one is 2070. When you go to your income statement, you see 2070. So it's 2070. Do you understand me? 2070. So that is that. Loss of fund. They said loss of fund, a director defrauded the company to the tune of this. What does that mean? Oh, before we go to that, we are under miscellaneous. Cost fine, we said is not allowable, have you?
yes.
Exchange losses or remittance and balance is allowable. This one is also allowable. Exchange loss is allowable. The same thing as exchange gain that will be taxable. Exchange loss will be allowable. Do you understand? The next one is loss of fund. A director defrauded the company to the tune of 9.8 million. That is not allowed. Defalcation is not allowed. I have told you. Legal and professional charge. Debt collection and retainership fee. Allowed. Abi? That one is allowed. Legal fee with regards to land acquisition. Is that allowed or not allowed?
Is allowable.
Good. Who else?
Not allowable, sir.
Who is that? Kelvin. Okay. Who else? Everybody has kept quiet now. You don't know. Who else? Not allowable. Abiola Adeyemo, not allowable. Okay. Can someone tell us the reason why it is not allowable? It's not allowable. Shola.
Because
Oh yeah, Kelvin, go ahead.
because it's a capital expenditure.
Thank you. It's capital in nature. It should be capitalized. Thank you, Adeyemo. It's capitalized. It should be capitalized. So it's not allowable. So that is that. So let's go to the solution. In the solution, we have net profits for the year. All the things that we have disallowed, we have brought them in. Now, that is not enough. When you are now done with the additional information, excuse me, you will now go back to the body of the question. You now go and be looking at this one after the other. Profit on disposal is not taxable. It's not taxable income. We will deduct it. We begin to look at this one after the other. Salary and director and remuneration, electricity, rent and rates, repairs and renewal, motor vehicle donation, interest on bank charges, bad debts. We have treated this. Depreciation is not tax, is not a liability deduction. So we add this back. So that is that. Depreciation is also added back. And we deducted profit on disposal. So that would be it. Now, in this question, the examiner said, what is the due date for filing returns? The due date is within 18 months from date of commencement and within 6 months after the first accounting year end. Whichever comes earlier. So that is that. The examiner also asks for commencement rule for the first 3 years. We have put it here. So that is that. Do you have any question? Let's look at one more question and we'll call it the lecture. We'll be rounding up this class in the next 10 minutes by the grace of God. Fortune, I'm going to send you assignment today. I said I was going to send you assignment last week. I did not. But today you will not escape it. I'll send you my assignments and you guys have to send it back to me. Okay? Fortune Nigeria Limited, a reputable soap company, making company is based in Lagos and registered over 10 years ago. The financial year end of the company is at 31st December every year. The financial position of the company for the year end at 31st December 2017 was as follows. We are given turnover, cost of sales, gross profits, other income. Given. Now, illustration 1. Sorry, additional information. Included in the other income is the sum of 850 earned as profit on disposal of fixed assets. Is that a taxable income or not taxable income? Please talk.
Non-taxable income.
Thank you, Amomi. Thank you. Your impact is felt. The next one. Salaries and wages included housing allowance for 10 senior staff were paid the sum of 200,000 per annum each. Is that allowable or not allowable? Who is telling us? Allowable or not allowable?
Not allowable, sir. It's my personal expenses.
Who else?
Allowable.
Allowable. Okay.
It's allowable, sir.
It is allowable. Okay. It is allowable. They are just giving you the details. Okay. Those 10 senior staff managements, they will be subject to tax under personal income tax. But as a company will pay this on their behalf. Do you understand? So it is a liability for the company. Next one. 1/4 of the expenses on rent was paid on the apartment occupied by the father of managing director. Allowable or not allowable?
Not allowable.
Why?
It's for personal use.
Thank you. The next one. Half of advertisement costs was incurred on sponsorship of television program where airtime was allocated for the promotion of their products. Allow or not allowable?
Allowable.
Allowable. Thank you. It is allowable. Public relation and entertainment of 3,150 included the sum of 308 paid as sales commission. Allowable or not allowable?
Allowable, sir.
Good. The next one. The breakdown of miscellaneous expenses as follows. Cost of computer hardware, allowable or not allowable?
Not allowable.
Not al-
Allowable or not allowable?
not
Not
allowable.
allowable.
Someone is still saying allowable. Computer hardware is capital in nature. It is not allowable. Next, furniture and fitting.
Not allowable.
Good. Cost of fuel and lubricants. Allowable or not allowable?
Allowable.
Allowable.
Printing and signaling.
Allowable.
Allowable.
Allowable. The next one. The amount included as gifts and donation is as follows. Donation to Egba Community Town Hall Development. Allowable or not allowable?
Not allowable.
Not allowable.
Donation to University College of Hospital Ibadan. Allowable or not allowable?
Allowable.
Allowable.
It is allowable.
Allow.
Fee to governorship candidates. Allowable or not allowable?
Not
Not
allowable.
Not allowable.
Next, subscription to ICAN. Allowable or not allowable?
Allowable.
Recognized trade association. Allowable or not allowable?
Allowable.
Allowable.
Type of institute of management. Allowable or not allowable?
Allowable.
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 We have said recognized trade association, so it is allowable. So having done that, we will now go back to the body of the question. We will go and look at it again. Which one have we not touched? Depreciation is not allowable. We add it back. Have you? And that is all. So the solution is 1/4 of the rent was disallowed. To be the solution. So good day to you. I'm going to be sending you your solution, your question today from beginning of the class to the end of the class today. So good day to you. And you will solve and send back to me via WhatsApp.
Okay, sir.
All right, guys. Have a nice day.
And you
Thank
too, sir.
You
Thank
too. Bye,
And
sir.
we'll see you again next week, Saturday. Next week, Saturday, we are going to be looking at capital allowance. We're going to be looking at allowance. And